Okay.
So I'm trying to log on so that I can share with you, but I'm having challenges. So this one is on my phone.
Okay.
So tell your people to give me additional 5 minutes. Let me relocate and see if it will be better.
Okay.
Thank you. Profit is taken by that same person, and then any liability or any debt is borne by that single person. So in a sole proprietorship business, the decision is taken by the sole proprietor or the owner of the business. The owner is the same person who is also running the same business. And so, in short, we said that liability and assets rest on the shoulders of the sole proprietor, which means that whether there's a gain or loss, is rest on it becomes the responsibility of the owner of the business. So if there's profit, it's for him. If there's a loss too, it's for him. Now, when you talk about final account is a group of various statements that I mentioned. The statement of profit and loss account, or statement of financial performance, statement of financial position, cash flow statement, and then the notes to the account. That is what we call final account. It is what is presented as the final record for public consumption or for decision making. Okay, so the final account is a final statement that provides a complete overview of a business financial performance, financial position at the end of the financial year. Now, when you look at it one by one, you see that the statement of financial performance talk about profit or loss. That is the activity of a business. And then when you look at the balance sheet, talk about the assets and the liabilities, and then the equity of the business. So it talks about the financial standing of the business. Then the next thing you look at is trading account. The trading account is the portion of the financial statement that have to do with determination of whether profit has been made on your trading activities, the direct trading activities, or a loss has been made on the direct trading activities. So we said that this is an account which is prepared to determine the gross profit or loss of a business. It has to do with the actual operation of the business. So all direct expenses that are directly related to the business operation is part of the trading account. When we get to this one, you'll see what it means. So what we are trying basically to say is that all your inventory, all your stock, both the opening and then the closing, and any direct expense that contributed directly to the running of the business or the running, the production is part of the trading account. So let me come by saying this. You know, in business, we have some expenses that are direct and some are indirect. Is that okay? Expenses that are direct. Abraham, you can unmute so that
yes,
I get
sir.
feedback from you.
Yes, please.
Expenses that are direct to business, they are the expenses that if you don't make it, there will not be activity. And so we call them direct expenses. And expenses that whether they are done or they are not done, the production will still continue. They are what we call indirect. Indirect. Okay. So, for instance, let's say school education. Payments to lecturers are direct expense.
Okay.
Payment to lecturers, they are direct expense. Accreditation of courses, expenses, they are direct expense. But when you come to security men's salary, they are not direct. Whether students come to learn or they don't learn, there will still be security people to protect the properties of the university. And so whether there is teaching or no teaching, that cost will still be incurred, or that expenses will still be made for the same people of the university. So those costs, they are indirect. They don't contribute to pay, producing a scholar. You understand?
Yes,
But
sir.
all the direct expenses which contribute to producing a scholar, you as a graduate, they are the direct things that you really use face to face or in that benefits you becoming a scholar. So, for instance, all examination costs are direct. Lecturers' payment, they are direct. Chalk or marker that you use, they are direct. Examination scripts and all those papers, they are direct. But things that do not relate directly to your production as a scholar, they are what we call indirect expenses. They are necessary, but we can't trace them directly to a student. Please, you get it.
Yes, sir.
So those are the direct and indirect. And you should be able to identify those things when maybe you enter into an organization. So for instance, when we come to manufacturing of slippers, let's look at manufacturing of slippers. When we're talking about the direct cost, we are talking about the labor that is having their hand in the manufacturing of the slippers. But administrative staff are not direct cost. Administrative staff expenses are indirect. So we are talking about rubber. Rubber that is used in producing the slippers is direct. The electricity that is used in producing the slippers is direct. But the electricity that is used in lightening the environment other than the factory, maybe the administration or the billboards around, those electricity costs are not direct. But when we come to the factory, the electricity cost that belongs to the factory is direct expense. Please, are we together?
Yes, sir.
Yes, sir.
So when we talk about trading account, we are talking about the stock and all the direct costs, the stock and all the direct expenses relating to the trading. Is that okay?
Yes, sir.
Usually, in that case, we say that wages are daily payments, unlike salary. Wages are daily payment to workers. So it is only in the manufacturing or production stage that we pay wages to people who have reported. And so anytime you see wage, it is seen as a direct cost. Is that okay?
Yes, sir.
Good. So when you prepare a trading account, we are expecting that it should give us the gross profit, the profit that you have made in comparing your cost of trading. When we say cost of trading, is the things you bring together to manufacture and the things you put together to go and sell them. That is the cost of trading. Against the sales you have made, it gives you gross profit or gross loss. Then now you can now consider the administrative expenses, which is indirect, advertising expense, which is also indirect, and other depreciation and other expenses. You can now consider them. Then you can get your net something. So we have the account divided into two components. The trading account, which has to do with the direct expenses and revenue. And then the profit and loss account, which has to do with the indirect expenses and other revenue other than the main sales of the company. Other incomes other than the main income of the company. So for instance, if it's the Chalewate manufacturing that we talk about, sales of Chalewate is the main revenue. But let's say you make an investment, the interest you receive is also an income, but it is not part of the main business of the organization. And so in the trading account, you now account for other incomes and all indirect expenses, So we say that the trading account is just an extension of the profit and loss account is just an extension of the trading account. So as you finish your trading account, you get the gross profit, then you add other income, and you now subtract all the indirect expenses from it. We'll see the components. Okay, so let's see a typical example of the trading profit and loss account, which we'll call an income statement. Now, this account is usually prepared at the end of the year. It's usually prepared at the end of the year. So we said that the heading is usually trading profit and loss account trading profit and loss account for the year ended. Then you put the date at which you are preparing the account, usually at 31st December of the year. So for instance, we say trading profit and loss account for the year ended 31st December 2025. That would be the heading of your trading account. Now, what do we consider? So look at this format. This is how the format is. And this format is something you have to learn by heart. You just have to learn this format by heart. Okay. It should just be in your mind by heart that this is what we do when you are preparing a trading profit and loss account. Okay. And so the first thing over there is the sales. The sales that you have made for the year. And you know, last time we realized that the sales can be gotten from your sales day book, transferred to the sales ledger, which you send the total to the trial balance. So you take it, that total from the trial balance is what you bring as your sales. So you see that sales here, and then we make XXX. XXX is as a figure. It's maybe 10,000 or 100,000. This is just the format of the trading profit and loss account. And so we put XS. XS represents the figure. And so this is how you go. The sales, you bring it, and then you bring you have made the sales. Anything they have returned to you is what? Your return inwards. So that will reduce the sales. So you subtract the return from the return inwards, the goods that the people have returned to you, you subtract it from the value of the total sales you have made. And that will give you the net sales. That will give you net sales. Are you with me?
Yes, please.
And then after that, you now less the cost of the things you have sold. How do you get the cost of the things you have sold? Is the opening inventory or the opening stock In other words, the goods that were there first, before you went and buy some to add to them, is what we call the opening stock or opening inventory.
Okay.
Is that okay?
Yes, sir.
Good. So you take the opening inventory, then you add any goods that you bought in addition within the whole year. You add it to it. You add it to it. When you add it to it, it gives you the total goods that are available for you to sell. Then you add expenses that you have made on transportation in bringing the goods to your shop. We call it carriage inwards. Carriage inwards. Every expense that you have made in bringing the goods to your shop is also an expenditure that you need to add to the cost of the goods. And so you add the carriage inwards. Then probably you may have also returned some of the goods back to the place you bought it from. And that is what we call return outwards. So you less the return outwards from your total goods that you have available, and that will give you your cost of sales. Your cost of sales. Then when you less, so what I'm talking about is here. Can you see the cursor?
Yes, please.
So the opening inventory, you bring it here, and then you come, the purchases that you have made, goods bought for resale, you bring it here. The amount you spend on the goods that you bought for resale, you add it to it.
Okay.
After adding it to it, you subtract the goods that you have returned to the people, and that will give you your net purchases. And when you add it to your opening inventory, it gives you cost of goods available for sale. Cost of goods available for sale. That is what we make here as COGAS or COGAS. Cost of goods available for sale. I would like you to write it in full in your notes. Cost of goods available for sale. So the cost of goods available for sale is your opening stock plus closing, opening stock plus your purchases, your carriage inwards, and then minus your return outwards. And then that will give you your cost of goods available for sale. Good. Now, the goods you have that is available for sale, but you have made a sale. Then there is some goods left at the end of the year. That is what we call the closing stock. So subtract your closing stock from the cost of goods available for sale. And it gives you the actual cost of the goods that you have sold. The actual cost of the goods that you have sold. After taking the cost, the closing stock from the cost of goods available for sale, you now have the cost of sale. Any question on that? Any question on that?
So please, the cost of
I don't
sale
expect you
is
to get it straight, so ask questions.
the cost of sale is kind of like the profits.
No. The cost of sale is kind of the total expenses you have made on the good that you have sold.
Okay.
You see, when you buy goods, you have the cost. When we say cost, is the value of the item.
Okay.
It's different from the selling price.
Okay.
Usually, the selling price is the cost price plus profit.
Okay.
Are we together?
Yes.
Usually, the selling price is the amount you bought the thing, and then you have also put some profit on it. That gives you the selling price.
Yes.
So the cost of sales is just the cost, the expenses you have made on the item.
Okay.
You didn't add your profit.
Okay.
So if you subtract your cost of sale from your sales, the actual sales, then it will now give you your gross profit.
Okay.
So other people who are not clear can also unmute themselves and ask questions.
Sir, please, can you go
We
over?
are here. We
go
are
over
here. And I want you to ask questions before we go on.
Sir, please, Mines, can you go over the whole thing again, like from the first? Because I've realized it's some sequence. So if you can go over.
Lift your voice more.
Okay, so can you hear me, please?
Yes, I can hear you now.
Yes, I was saying if you can kindly go over the table again, because I've realized it's a sequence, it follows, and each order is
I should go over
important.
the whole thing.
Yes,
Is it the whole show?
Yes, the whole show, sir.
Is it the whole show that you want us to go
Yes,
over?
please. Yes, please. Yes, please.
Or a specific area?
I would like you to go over the
Do
whole
you
thing
understand
again.
the sales and then minus the, or less the return, sales return? You
Yes, the sales return. Yes,
understand
please.
that
The
side?
sales.
Up to the
Yes,
net
the sales
sales.
return.
You
Yes. So the
understand that
problem,
one?
the problem comes from the net sales. Right after the sales return, the net sales.
Okay. So you are okay with the net sales?
No, that is where the problem is. So right
The
from
net
there.
sales, I said that your total sales that you have made is the sales. When people return some of the thing you sold to them to you subtract that figure from the total sales that you have made. Let's say you make a sales of 1,000, and some people said, oh, after buying the thing, they didn't like some, so they return 500 to you. So you subtract the 500 from the 1,000, your net sale is now 500. You understand now?
Okay. Yes, sir.
So yeah, so that is the net sale. Then we are also saying that the thing that you sold, how much did you spend in getting the thing? How much do you spend in getting the thing? The amount you spend in getting the thing is what we are saying that the old stock that you have, the old stock or the old goods that you have, plus the new goods that you bought all over the year, the total of what you bought in the year, you add it to it. And then the expenses you made in bringing the goods to your shop, you add it to it. Then you subtract any goods you have returned to your suppliers, which is the return outwards. The goods you bought, you have returned some. So you subtract it from it. Are you getting to that level?
Okay, sir. Yes, sir.
So
Yes, sir.
we are looking at your net purchases. Your net purchases is what you have purchased. You subtract what you return out of it. So let's say you went to purchase 1,000 cedis of item to come and sell. But when you brought the thing to your shop, you realize that 200 is not the standard you want. So even though you bought 1,000, you return 200 to the people, and then they will give you your money. So you subtract that 200 from the 1,000. So the actual purchases you have made is 800. Are you okay with that?
Yes, sir. Yes, sir. Yes, sir.
So the actual purchases is 800. Then we are saying that you don't just take that as the cost of your purchase. Add any expenses you have made in maybe transport, in bringing the thing to your shop. Add that cost to it. Add that cost to it. Then it now gives you the actual cost of the thing you are selling. Is that okay? Do you understand up to that level? Yes, Stephen. Stephen, you can talk. Yes.
So please, with the columns, I can see 4 columns over there. So in terms of retaining the items, which of the columns should we use? With the Ghana Cedis one?
You see, you have 3 columns.
Yes,
The
sir.
first column was meant for the sales. And then the second column The first and the second column, they are there for adjustments.
Okay.
They are there for adjustments. And so we are saying that the opening stock, which is the opening inventory, you bring it here. Then the purchases you have made, you bring here because you'll be adjusting the purchases. So, hush. Because you'll be adjusting the purchases, you come with the carriage inwards, and then you take the return outwards. And that gives you a net purchase. So you bring it to come and add to the opening stock. And that's when you add it, it gives you the cost of goods available for sale. Then when you subtract the closing inventory from it, then you now get the cost of sales. Then you now get the cost of sales. Then you add any direct expense in the manufacturing, direct manufacturing cost, which is wages. You add it to it. When you subtract it from the total net sales, then you are now getting your gross profit. Is that okay?
Okay, sir.
Very well. I want to send you the slides, and then you go through this thing. We'll take a 15 minutes break, and I will come back.
Okay.
Okay.
Thank you.
That'll be nice, sir.
Rare.
So you look at it from what I have just said. You look at it carefully, and then when we come back, you can come with all your questions, and then we'll move on. If I had okay, last week we were you were also tired. If I know, would have introduced you to this on.
Rare.
Yes.
Yeah, so please, I'm thinking by our next lecture is 11:15 and it is almost 11 o'clock. So if maybe we can schedule in the course of the week a day that's
Today, what time?
a day that will be favorable in the course of week, then we try and adjust to it so that we can go through. Yeah.
I'll send the document.
Yes,
I'll
please.
send the document. So discuss with your people, and then I need another 1 hour.
Okay.
I need another 1 hour. So tell me when you can get that 1 hour. You communicate it to me, so
All
that
right.
we take it. I will take it from there.
All right, sir. Thank you.
All right. Take your time and read through the things.
Okay, please.
Yes, sir.
It's self-explanatory, but read through and then get back to me. So discuss with your people. Let me know 1 hour that would be good for you, whether in the evening or during the day. I want to know.
Okay.
So that
all right.
But I think
Thank you.
I prefer early in the morning or after 6.
Okay, sir.
Thank you.
You're welcome, sir.
I wish you well.
Amen.
Wish you safe.
Amen.